Disclaimer.
Something broke in our silver market during the first week of December 2025, and most Americans missed it completely. While financial media focused on holiday shopping predictions and year-end stock rallies, the COMEX vaults in New York hemorrhaged 47.6 million ounces of physical silver in just 4 trading days. That's not a normal withdrawal pattern. That's a full-blown emergency. Think about what 47.6 million ounces actually means. We're talking about 60% of the entire registered inventory, the metal actually available for delivery, vanishing faster than any short squeeze in modern commodity history. The December drain exceeded the total monthly withdrawals from any period during the 2011 silver peak, the 2020 Reddit-fueled surge, or even the inflation panic of 2022. This wasn't retail investors getting excited. This was something far more calculated, far more significant. Here's where the story gets fascinating. According to the December 2024 CFTC Commitment of Traders report, U.S. commercial banks flipped to a net long position in silver for the first time in the history of the data series. Read that again. The same banks that spent decades suppressing silver prices through massive short positions suddenly reversed course entirely. And during this exact 90-day window, silver exploded from $30 per ounce to $79. That's not coincidence. That's orchestration. Pop quiz. Which bank do you think led this reversal? If you said JP Morgan, you understand how our financial system actually works. The institution that paid nearly $1 billion in fines for manipulating precious metals. Markets between 2008 and 2016 apparently learned a valuable lesson, not to stop manipulating markets, but to flip sides and ride the wave they'd been holding back for over a decade. Let me put the scale of this move in perspective. JP Morgan didn't just close out short positions. They reportedly built the largest private silver stockpile in history while simultaneously allowing, or perhaps engineering, the tightest physical market conditions in generations. Think of it like this. Imagine someone spending years telling everyone a particular neighborhood would never appreciate in value, keeping prices depressed, then quietly buying every property they could before announcing the area's redevelopment. That's essentially what happened in our silver market, except the stakes involve hundreds of billions of dollars and the integrity of commodity price discovery itself. The vault data tells a story our financial media refuses to connect. Registered silver inventory, the category that matters for actual delivery, hit just 33 million ounces by late December. To understand how critical this number is, we need to go back to February 2021, when COMEX registered stocks stood at 152 million ounces. We've lost nearly 80% of deliverable metal in less than 4 years, and the pace of depletion is accelerating, not stabilizing. But here's what should really grab your attention. The registered silver ratio, the percentage of total vault holdings actually available for delivery, crashed to 11.1% in December 2025. According to CME Group data, this represents the lowest ratio in 22 years of recorded history. We haven't seen numbers this tight since the early 2000s, before the exchange even began separating registered from eligible categories. The system is literally running on fumes. Now let's talk about what this means for paper contract holders. Current COMEX positioning shows 18.3 paper contracts for every single ounce of registered physical silver. Think about that math. If just 5% of open interest holders decided to stand for delivery instead of rolling contracts or taking cash settlement, the entire registered inventory would be completely drained. Not stressed, not tight. Completely gone. Have you noticed how the situation differs from every previous silver rally? In 2011, when silver peaked near $50, COMEX inventories were robust and growing. During the 2020 Wall Street Bets surge, the exchange had plenty of metal to satisfy delivery demands, which is why prices corrected quickly once the social media frenzy cooled. But December 2025 is fundamentally different. We're not dealing with speculative enthusiasm overwhelming a healthy market. We're watching a structural supply crisis unfold in real time, while the institutions that created the problem position themselves to profit from the chaos. The Federal Reserve's own data confirms something remarkable about this moment. U.S. commercial banks reported their largest one-quarter shift in commodity positioning on record during Q4 2024, with precious metals accounting for the bulk of the move. When you combine this information with the CFTC's Commitment of Traders data, showing the net long flip, a clear picture emerges. Our largest banks knew what was coming and repositioned accordingly, while public traders remained largely short or neutral. Here's the part that should concern every American with savings in dollars or investments in traditional assets. The paper silver market, futures contracts, unallocated accounts, exchange-traded funds without full physical backing, has operated for decades on the assumption that most holders would never demand actual metal. The system works beautifully as long as everyone plays along, rolling contracts forward, accepting cash settlements, trusting that their paper claims represent real assets. But what happens when that assumption breaks? December's vault drain suggests we're finding out. The claims per ounce ratio keeps climbing while physical inventory keeps falling, creating a mathematical impossibility that must eventually resolve. Either prices rise high enough to destroy paper demand, or the exchange implements forced cash settlement, or new supply materializes from somewhere. Given that global mine production has been essentially flat since 2016 according to the Silver Institute, and given that China just banned silver exports on November 3rd, 2025, that third option seems increasingly unlikely. Think about your own financial position for a moment. If you hold silver through an ETF, do you actually own metal, or just a claim on metal that might not exist? If you trade silver futures, do you understand the counterparty risk involved when registered inventories sit at 22-year lows? These aren't theoretical questions anymore. The December delivery data turned them into practical concerns that every position holder needs to address. The most telling detail might be what JP Morgan did while everyone else panicked. According to trade sources and vault tracking data compiled by precious metals analysts, the bank didn't just flip from short to long on paper. They reportedly accumulated physical metal on a scale that dwarfs even government stockpiles, positioning in Singapore and London while COMEX bled inventory. That's not the behavior of an institution worried about a temporary squeeze. That is the positioning of an entity that knows exactly what's coming and has decided to own the asset rather than fight it. We're watching the greatest reversal in commodity market history unfold, and most Americans have no idea it's happening. While retail traders debate technical chart patterns and financial pundits discuss inflation hedges in abstract terms, the banks that once suppressed silver prices have quietly switched sides. They're no longer asking whether the paper market can hold. They're asking how much real metal they can accumulate before everyone else figures out what's actually happening in our vaults. The trigger point came on October 8th, 2025, and it happened in London, not New York. India's government placed an emergency order for 1,000 metric tons of silver through the London Bullion Market Association, roughly 32 million ounces, for immediate delivery to support their expanding solar panel manufacturing initiative and strategic reserve program. Within hours, the entire London physical market seized up like an engine running without oil. Here's what most Americans don't understand about how global silver trading actually works. London serves as the world's central clearing hub for physical precious metals, where mining companies, refiners, industrial users, and financial institutions meet to settle actual metal transfers. Unlike COMEX futures, which primarily involve paper contracts that rarely result in delivery, London deals in real bars moving between real vaults. When London freezes, it means the physical shortage isn't some future possibility. It's happening right now. The lease rate spike tells you everything about the panic that followed India's order. Silver lease rates measure what it costs to borrow physical metal for short periods, and they normally hover around 1.25% annually because silver is abundant and easy to source. On October 8th, those rates exploded from 0.25% to over 200% within 48 hours, according to London Bullion Market Association data. Think about what that means. Institutions with short positions or delivery obligations were suddenly willing to pay 200 times the normal rate just to secure metal they'd promised to deliver. That's not market stress. That's absolute desperation. Then Metalor, one of Switzerland's premier precious metals refiners and a crucial link in the global silver supply chain, made an unprecedented announcement. They would cease accepting new silver refining orders until January 2026. Let that sink in. A refinery that's operated continuously through world wars, financial crises, and every market disruption of the past century essentially said they couldn't source enough raw material to meet commitments. When Swiss refiners withdraw from the market, you know the shortage is real, not manufactured hype or speculative fever. But here's where the JP Morgan story gets really interesting. According to multiple trade sources and silver vault tracking analysis, the bank accumulated approximately 750 million ounces between June and October 2025, before the London freeze, before the refinery withdrawals, before the obvious crisis became undeniable. That's roughly 23 to 300 metric tons, which would make it the largest privately held silver stockpile in world history, exceeding many sovereign nation reserves. How do you quietly acquire 750 million ounces without moving the market? You do it over 4 months, through multiple entities, multiple jurisdictions, using every vault and storage facility from Singapore to Switzerland to London. You buy when mining companies need to hedge production, when industrial users liquidate inventory during seasonal slowdowns, when ETFs experience redemptions. You become the bid of last resort at every price level, accumulating steadily, while your trading desk maintains just enough short positions on COMEX to keep paper prices suppressed and prevent premature awareness of what's actually happening in physical markets. Think about the timing. JP Morgan finished accumulating in October, just weeks before China dropped their export ban bombshell on November 3rd, 2025. China had been the world's largest silver exporter, shipping over 5,000 metric tons annually to global markets. When Beijing announced that all silver exports would cease indefinitely to support domestic strategic initiatives and advanced manufacturing, they effectively removed 15% of tradable global supply overnight. Did JP Morgan know this was coming? Or did they just read the same signals we're analyzing now and position accordingly? The Shanghai Futures Exchange data reveals the Eastern shortage developing in parallel with London's crisis. Chinese silver stocks fell below 446 metric tons by November, the lowest level in over a decade, according to Shanghai Exchange inventory reports. For context, those same warehouses held over 1,200 tons as recently as January 2024. We're talking about a two-thirds collapse in Chinese available inventory within a single year, all while their industrial demand for solar panels, electric vehicles, and electronics continued accelerating. Now, let's connect this to what happened on COMEX, because this is where the paper illusion started shattering. Futures market backwardation, when near-term contracts trade at higher prices than distant contracts, reached an unprecedented $3,000 per contract spread between December 2025 and March 2026 deliveries. In a normally functioning commodity market, this situation should not exist because traders would immediately buy the cheaper distant contract and sell the expensive near contract, capturing the spread. But that arbitrage only works when you can actually deliver physical metal. When you can't, the normal rules break down entirely. Even more revealing was the cash futures basis, the difference between spot physical prices and futures contracts. By mid-December, COMEX futures were trading 60 cents below London spot prices, despite normally commanding a small premium. According to CME Group settlement data, this inverted relationship persisted for over 3 weeks, the longest sustained inversion in modern COMEX history. The message was clear. Paper promises had become worth less than physical metal, and the market knew it. Have you considered what it means when the paper market and physical market completely decouple? For decades, COMEX futures set the global price benchmark for silver. Mining companies hedged production based on COMEX quotes. Industrial users budgeted purchases using COMEX prices. Investment funds valued their holdings according to COMEX settlements. But what happens when COMEX trades at $30 while you need to pay $35 to actually buy physical metal in London? Which price is real? This is where JP Morgan's Singapore positioning becomes crucial. While COMEX fractured and London seized, JP Morgan expanded their storage and trading operations in Singapore, positioning themselves at the intersection of Eastern demand and Western supply. Singapore offers several strategic advantages: proximity to China and India, sophisticated vault infrastructure, and a regulatory environment conducive to large-scale precious metals trading. By moving operations eastward, JP Morgan positioned to arbitrage the growing premium spread between desperate Asian buyers and distressed Western paper holders. The lease rate curve tells the rest of the story. According to London Bullion Market Association forward rate data, leasing silver for 12 months out now costs over 50% annually, while leasing for immediate delivery remains at extreme levels. This steep contango in borrowing costs reveals something remarkable. The market expects shortages to persist for at least another year, possibly longer. When institutional players price in sustained scarcity that far forward, they're not worried about a temporary squeeze resolving quickly. They're pricing in structural supply deficit that changes the game permanently. Let me paint a scenario that illustrates what's happening. Imagine you're an electronics manufacturer in South Korea who needs 100,000 ounces of silver monthly for conductive paste in solar panels. You've always bought futures contracts on COMEX and taken delivery when needed, paying the futures price plus minimal delivery charges. But now when you stand for delivery, you're told the vault is empty and you can accept cash settlement instead. The cash settlement comes at the COMEX paper price of $30 per ounce. Meanwhile, the only way to actually acquire physical metal for your factory is to pay $35 or more in the spot market. You just lost $5 per ounce, $500,000 monthly, because your paper contract proved worthless when you needed actual metal. Now multiply that scenario across thousands of industrial users, investors, and institutions worldwide who believed their paper claims represented real assets. The wealth transfer currently underway rivals anything we've seen in commodity markets. And it's happening largely invisible to Americans who don't follow vault data or lease rates or futures basis spreads. The Swiss refinery withdrawal, the London freeze, the Chinese export ban, the Shanghai inventory collapse, the COMEX backwardation, the lease rate explosion. These aren't isolated events. They're all symptoms of the same underlying reality. The physical silver market cannot meet demand at anywhere near current price levels, while the paper market continues operating on the fiction that unlimited metal exists somewhere. JP Morgan apparently recognized this divergence months before it became obvious and positioned to own real metal rather than paper promises. That decision might be the most profitable trade of the decade, and most Americans still don't know what happened. The question we need to ask ourselves isn't whether the paper market can survive. The question is, what happens to our dollars, our retirement accounts, and our financial system when one of the oldest commodity markets in history breaks down completely, and when the institutions that once suppressed prices have quietly switched sides? We're about to find out. January 2026 is shaping up to become the most critical delivery month in COMEX silver history, and the warning signs are already flashing red across every metric that matters. Open interest for January contracts currently sits at the highest level ever recorded, for what's traditionally considered a minor delivery month, according to CME Group positioning data. When traders pile into a typically quiet month with this kind of intensity, they're not making routine hedging decisions. They're making calculated bets that something breaks. Let's do the math together, because these numbers tell a story our financial institutions desperately don't want you to understand. COMEX registered inventory stands at just 33 million ounces after December's massive drain. Meanwhile, open interest represents claims on over 600 million ounces of silver. That's an 18-to-1 ratio of paper claims to physical metal available for delivery. Now here's the critical question. What happens if even a modest percentage of those contract holders decide they want actual metal instead of rolling forward or accepting cash settlement? The delivery completion rate reveals the system already cracking under pressure. According to COMEX clearing data, only 7 to 7.6% of December delivery notices resulted in actual metal transfers, the lowest completion rate since March 2020, when COVID lockdowns disrupted global logistics. But we don't have lockdowns now. We don't have force majeure conditions. We just have a market where 3/4 of delivery requests get satisfied, while 1/4 get, cash settlement at paper prices while physical premiums surge. This is how a market breaks, one failed delivery at a time. Think about what you would do in this scenario. You bought silver futures contracts months ago at $28 per ounce, planning to take delivery for your manufacturing facility or investment portfolio. January arrives, you submit your delivery notice, and the clearinghouse informs you that physical metal isn't available. They'll happily settle your contract at the current COMEX price of $32 per ounce, a nice $4 profit on paper. But when you try to actually buy physical silver in the spot market to replace what you didn't receive, you're paying $38 per ounce. Your profitable futures contract just cost you $6 per ounce in real terms, plus the time value and opportunity cost of having capital tied up in worthless paper promises. Now multiply that scenario across every industrial user, every investor, every institution holding COMEX contracts who suddenly realizes their derivative exposure doesn't translate to actual asset ownership. The wealth transfer we're witnessing makes the 2008 mortgage-backed security crisis look simple by comparison, because at least with mortgage securities, everyone eventually understood that the underlying assets were toxic. With silver futures, most holders still believe they own metal. They just own promises that may never be kept. UBS commodity analysts released projections in early December calling for silver to reach a baseline range of $55 to $65 per ounce during Q1 2026, driven purely by fundamental supply-demand dynamics without accounting for any liquidity squeeze or delivery failures. Their analysis points to the 295 million ounce supply deficit documented by the Silver Institute, the deepest structural deficit on record, exceeding even the shortfalls of the 1980s when the Hunt brothers attempted their infamous corner. But here's what makes UBS IA's conservative estimate potentially laughable. They assume the paper market continues functioning normally and new supply responds to higher prices. Both assumptions look increasingly questionable. When you factor in liquidity squeeze potential, the scenario where delivery failures cascade and physical premiums completely decouple from paper prices, UBS analysts suggest $80 to $100 per ounce becomes plausible, possibly even conservative. At $100, we're talking about a 233% increase from the $30 levels that prevailed just 4 months ago. For perspective, that magnitude of move in such a short time frame would exceed silver's legendary 1980 peak in inflation-adjusted terms, and rival the percentage gains seen during the 1970s bull market that took 9 years to develop. Have you checked what's happening to physical premiums at your local coin dealer lately? According to retail precious metals tracking data, American silver eagles are trading at $8 to $12 premiums over spot COMEX prices, while generic rounds carry $4 to $6 premiums. That spread has roughly tripled since September 2025. When Main Street investors are paying $40 for an ounce of silver that supposedly trades at $32 on COMEX, the paper market has already lost price discovery credibility where it matters most: actual transactions involving real metal. The SLV situation deserves special attention because millions of Americans hold this ETF in their retirement accounts, believing they own silver. Here's what the prospectus actually says, buried in the legal language most investors never read. The trust holds silver in allocated and unallocated accounts. And in circumstances where physical metal cannot be sourced, the sponsor may suspend redemptions or creations. Translation: when the shortage gets severe enough, your shares might become unredeemable at any price, or redeemable only for cash at whatever paper price the market assigns, not the much higher physical premium that real metal commands. Let me walk you through what we're likely to see unfold between now and March 2026. First, January deliveries will stress the system further as more contracts stand for delivery than COMEX can physically satisfy. Some deliveries will succeed, draining registered inventory toward zero. Others will result in forced cash settlement or delayed delivery notices that push obligations into March. Second, physical premiums will continue widening as Eastern buyers outbid Western paper holders for the shrinking pool of available metal. Third, some combination of events, perhaps a major industrial user publicly failing to secure contracted metal, or a mining company defaulting on forward sales commitments, will trigger broader awareness that the emperor has no clothes. At that point, one of two things happens. Either COMEX dramatically increases margin requirements, implements position limits, or restricts delivery to commercial hedgers only, effectively breaking the futures contract, its promise of physical settlement, and destroying the exchange's credibility. Or prices rise so violently that paper demand collapses because speculators can't afford margin calls and industrial users source metal through alternative channels. Both outcomes result in the same conclusion. The paper market loses its century-long grip on silver price discovery. The counterparty risk question cuts to the heart of how you should position yourself. If you hold unallocated accounts at banks or dealers, you own a general claim on a pool of metal that may be pledged to multiple parties. Think of it like a gym selling 10,000 memberships but only having equipment for 200 people. It works fine as long as everyone doesn't show up at once. If you hold futures contracts, you're exposed to clearinghouse solvency and the exchange's willingness to honor physical delivery. If you hold certain ETFs, you're depending on the sponsor's ability to source metal during a global shortage. What's the alternative? Sovereign coins from government mints, American Eagles, Canadian Maples, Austrian Philharmonics carry legal tender status and universal recognition, though you'll pay higher premiums. Allocated storage with segregated identified bars in your name eliminates counterparty risk, though you'll pay storage fees. Physical possession removes all intermediaries but requires security considerations. The common thread across all these options: you need to own actual metal with clear title, not paper claims that might evaporate when you need them most. Here's what keeps me up at night thinking about this situation. The Silver Institute's 295 million ounce deficit is not some speculative projection that might happen if certain conditions align. It's already happening. Mine production has been flat since 2016, while industrial demand, especially from solar panels and electric vehicles, continues growing by double digits annually. Recycling cannot possibly fill the gap because most silver goes into applications where recovery is economically unfeasible. And now the countries that historically exported surplus production, China, Peru, Mexico, are either banning exports or prioritizing domestic use. Western vaults are depleting to feed Eastern demand that structurally cannot be reversed without massive price increases that would reshape the entire commodity market. Think about the implications for our broader financial system. If silver, a relatively small, simple commodity market, can reach the point where paper prices and physical prices completely diverge and the futures exchange can't guarantee delivery, what does that say about other derivatives markets? What happens when the same dynamics hit copper or platinum or any other critical industrial metal trading on thin physical inventories with massive paper claims? JP Morgan positioned for exactly this scenario. While most banks reduced commodity exposure after the 2008 financial crisis, while regulators implemented tighter controls on physical trading following manipulation scandals, JP Morgan apparently decided that owning the actual asset outweighed the risks of getting caught suppressing prices again. Their reported 750 million ounce position will be worth north of $40 billion if silver reaches just $55 per ounce, a conservative estimate that does not account for liquidity squeezes or delivery failures. If prices spike toward $100, we're talking about $75 billion in profit on a trade that most market participants didn't even know was happening. The beautiful irony of this whole situation is that the same institution that paid nearly $1 billion in fines for manipulating silver downward has now likely profited 100 times that amount by flipping to the long side, right before the shortage they helped create became undeniable. It's legal, it's brilliant, and it perfectly illustrates how our financial system actually works versus how we're told it works. The rules apply differently when you're big enough, connected enough, and sophisticated enough to see what's coming before everyone else. So what should you do with this information? First, understand that the system we've relied on for price discovery in precious metals is breaking in real time, and the breakdown will accelerate through Q1 2026. Second, evaluate any silver exposure you have and honestly assess whether you own metal or paper promises. Third, recognize that the same banks that once told us silver would never rise have completely reversed their positioning, which tells you more about where prices are headed than any analyst report or economic forecast. The 60% vault drain we started this story with wasn't an anomaly. It wasn't a temporary squeeze that will resolve once speculative fervor cools. It was the beginning of a structural supply crisis that will fundamentally reshape silver markets and potentially our broader understanding of commodity market integrity. Those 47.6 million ounces that vanished in 4 days represent the future arriving ahead of schedule. A future where paper claims and physical reality finally decisively diverge. JP Morgan saw it coming and positioned accordingly. Now you know too.